Yeah, today is the fourth day. We'll be learning about the topics I put it on the screen itself. I will be talking about forfeiture of exemptions or losing exemptions, when I may lose tax exemption for charitable organization. We'll be talking about the registration, revaluation, renewal, and finally the cancellation part of it, because that's more important for us. We'll be learning about cancellation and also the exit tax, which government has introduced. I mean, it is there for quite some time. Earlier it was called as tax on accidental income. Now it is called as exit tax. We're learning about that. And taxation under specified circumstances. Okay, because I've been talking about all the 3 days about the various violations, and I told you that the violations will be taxed at a special rate. What are those special rates? When it will be taxed? We'll be learning all these things. Okay, right? Um, we'll move forward now. Before we get into any other topic, let's look at the non-availability of domain benefit of section under section 11 or forfeiture of section 11 and the penal consequences. What are the consequences of forfeiture? We learn about it. In section 13, when it talks about when an organization may lose its tax exemption. Okay, may lose its tax exemption and get into penal consequences. Okay, right? Section 13.1 talks about 4 different instances when an organization might or will lose tax benefit. 4 different instances or circumstances in which a charitable organization will lose its tax benefits. The number one is that the first one is that a public religious trust not functioning for public. The public religious trust not functioning for public. What is this public religious trust not functioning for public? Let's take the example. Of course, this is not common among the Christian circle. This is a religious trust. And let's say you registered a religious trust, and the purpose of the trust is to run or maintain churches. So what you do is that when you construct, you raise donations, funds, and then you enjoy all tax benefit, and the church building comes. Afterwards, you tell the people, the congregation, no, this church belongs to only my family. Only my family, my wife, my children, my parents, my brothers, sisters, only they will come and worship. Others are not allowed inside this church. You cannot come and worship with us. You are prohibited from enjoying the benefit of worship in this church. In which case, the public religious trust, this is not functioning for the public. It is restricting the benefits to the private, to few individuals, to the family. So such cases, you will lose tax exemption. Section 11 will not be available. When you don't get section 11, how it will be computed, we'll come to that little later. Okay, right? And then the next one, this is section 13.1b. I mean 13.1b. This is, in fact, a lot of litigations are going on even now. Okay, and often this is a misunderstood section. What the section says, the 13.1b subsection says that a public charitable trust income is applied for a particular religious community. It is public charitable trust income is applied for any particular religious community. It is not that a public charitable trust carrying on religious activity will lose its tax exemption. 13.1b is not that. Okay, 13.1b is a public charitable trust income is applied for a particular religious community. Next, for example, you have registered a trust for giving educational assistance, scholarship, support to students. And what you say is that this scholarship you have registered as a public charitable trust, you are enjoying tax exemption. And what you say is that after raising funds, you say, no, this money, this scholarship will only go to Christian children. others are not eligible to enjoy benefit, then the trust will lose tax exemption. Okay. Let me repeat again. It is public charitable trust. Income is applied for a particular religious community. Let's take the example of schools. When we take Christian schools, we want to get minority exemption. One of the conditions for minority exemption is that the beneficiary should be by and large Christians, minorities. That is the idea in which the minority status is given to the educational institution. When we have minority exemption status, tax department many times, almost every time, they will object saying that you are registered, you have created a school for benefiting only the Christians. Why should I give tax benefit to you? Okay. In fact, this question was raised by the department very recently also when we applied for tax exemption. Thankfully, there are few judgments which says that even though the institutions have minority status, most of the students, beneficiaries are non-Christians, so the benefit should be extended. But unfortunately, this is not the understanding of the tax department. Only now they are slowly getting to understand. What has been the understanding in many cases is that the administrators think that if the money is applied for religious purposes, then they say, if you apply it for religious purposes, then they say you have violated section 13(1)(b). Take the example here. This is a decision in the Chennai Tribunal, where a congregation, Little Flower Educational Society, they contributed their funds to their mother house, parent body. And that parent body is registered as a religious trust, and the tax department levied taxes, saying that 13(1)(b) is attracted. You're not eligible for exemption under section 11. So they levy taxes on the gross income at 30%. And then they filed an appeal before the commissioner, they lost it. Before the tribunal also upheld the assessing officer's finding order, saying that you are not eligible for tax exemption. At the time of hearing before the tribunal, this society, this educational society represented, saying that what I contribute to my parents' house, even though they are registered as a religious body, they have many institutions. They run schools, they run hospitals, they contribute to the various one. The parent body, the mother house, may collect all the funds from the different institution and gives it to the needy institution. And end of the day, ultimately, they said the beneficiaries are all non-Christians. But tribunal did not agree with that. There is one more also I've given here. So, moment when you violate 13(1)(a) or 13(1)(b), you will not be eligible for any of the exemptions that we talked about. We talked about 6 types of exemptions available. None of them will be available to the organization. The next one, I'll take 4 and then come to the third one. Investments in modes other than 11(5). I've been talking about 11(5), and yesterday I think I showed the list outside. So you are expected or you are mandated to keep your surplus funds only in 11(5) mode. What is this 11(5) mode? We talked about yesterday. These are all by and large safe investments, except perhaps the mutual funds. These are all by and large safe investments. Government expects you to put your money in safe places. The moment when you put money in other places, because a lot of other organizations or other companies offer much better return. And there are some private players who promise even bigger return. That is why we see a lot of scams every now and then. We hear that. Some of them are at national level, some of them are at small level. We are hearing that. But government says you better put your money in safe investments, safe places. So you need to keep the money in sub 11.5 mode. When you do not put the money in 11.5 mode, you do not have exemption under section 11. You lose the exemption under section 11. Thankfully, the government has introduced a new stream of taxation for us. Otherwise, our gross income was subject to tax at MMR, maximum marginal rate. What is that maximum marginal rate? We'll come to that little later. The last one, where I want to spend a little more time, income applying directly or indirectly for the benefit of specified persons. We are using the word both directly and indirectly. And they're also using the word benefit. Okay, right? When you benefit the specified persons, we'll come to the specified person later now. When you benefit the specified persons, either directly or even indirectly, okay, right? Then the organization loses tax exemption. Okay, the various exemptions we talked about. I mean, application of income, 85% application. When you're not able to spend in 1 year, option under section 11.1, explanation 2, or accumulation or setting apart under section 11.2, corpus donation, capital gains, none of them will be available to you. Okay, right? None of them will be available to you, and you will have to pay taxes. Till the last year, it was at MMR. Thankfully, government has introduced a new main section, a new scheme of taxation, under which you will be paying taxes. We'll understand the new scheme of taxation. So, what is this benefit? Okay, we will see this. What is this benefit? They're also talking about directly or indirectly. It is not that you directly pay remuneration to them. It is not that you benefit them directly, even indirectly. When you give benefit to them, then you are at risk. Who are all the specified persons? Author or founder of the trust. I don't need to explain much about it. Any founder, any author, okay, anyone who was created. In case of society, it is the subscribers to the memorandum, or it can be even the trustee or manager. Manager, what they say is that by whatever name called of the institution, not necessarily the society. Even if we have institution, the manager here means the trustee, and the manager here includes even the board members. Okay, right? Specified person includes trustee, board members, or when they say manager of the institution, I mean, it can even go beyond that. Supposing you have state association, and the state of association offices also could be included on that. And we'll come to that later. That any person who has made substantial contribution to the trust or institution. What do they mean by substantial contribution? Here they say substantial contribution means 50,000 rupees, more than 50,000 rupees, up to the end of the relevant financial previous year. Supposing you have a member in your church, because we have in the church a habit or practice of collecting either subscription or tithe from our members, regular members. Let's say that member is contributing every month 1,000 rupees. Okay, so in a year you will contribute 12,000 rupees. In 4 years, you would have contributed 48,000 rupees. In between, if he has contributed any special offering, like birthday offering and things like that, if it exceeds 50,000 rupees, then he will be a specified person. And in which case, the trust or the church should not benefit the member directly or indirectly. What do we mean by indirect benefit? Let's say you have a sale in the church. Okay, right? For fundraising, you have a sale. Let's say you are selling everything. Let's say you are selling. Let's say you are selling Bibles at the rate of 1,000 rupees to everybody. I'm just giving an illustration, hypothetical illustration. You are selling Bibles at 1,000 rupees to everybody. And the people who have contributed more than 50,000 rupees to you up to that period, you give them Bibles of 1,000 rupees, you give them 500 rupees, that will be benefit. And when you benefit people, then the trust loses exemption. Section 11 is not available. Okay, you lose the benefit under Section 11. So you need to be very careful when you're benefiting. So this is a very dangerous clause, this 50,000 rupees. And when you have these people, please make sure that there is no benefit going to them. What is the idea behind this? Government wants us to treat charitable organization or religious organization as charitable and religious organization. Take the case of a company or a partnership. Let's take the example of a company. When I buy shares in a company, when I invest in a company, what do I expect? I expect returns from the company. Supposing I put 10,000 rupees investment in the company and buy shares, I expect dividend from the company. I expect wealth creation in the form of the share value going up. But you should not expect any of these things with the charitable organization. When you donate to the charitable organization, when you donate to the church, when you donate to a mission organization, that's it. Forget it. Do not expect any favor from the organization, any concession from the organization, purely because you have contributed some amount to the church, purely because you have contributed some amount to the institution. Supposing the church runs a school, okay, because you have contributed more than 50,000 rupees, right? Your children should not be given free education. Your children's fees should not be given at concessional rate. Then you have a problem. Okay, right? When they're talking about HEF, let's not worry about HEF because we don't have HEF main concept for us. And they're also talking about all these four categories. They're talking about any relative. Okay, right? Any relative of the author, founder, person, member, trustee, manager, which includes your board member, as aforesaid. Okay, right? Of course, the contribute, this is not included for the purpose of relative. Here, this and this are included. Okay, any relative. So what are those relatives? We'll see the relative and come to the concerns in which substantial interest. I mean, this is the list of relatives for your easier understanding. I put this in the form of a chart so that you can understand it easily. Take the example of individual. He and his spouse, okay, he and his wife are specified persons. Their parents, husband's parents, grandparents, wife's parents, grandparents are specified persons. Not only that, their children are specified persons. Okay, their son, daughters, grandchildren, and in their children's grandchildren, their spouses. Supposing your son gets married, his wife is also included as a specified person. Their children, your son's children, and their spouses, all of them are included under the specified persons list. Not only that, in case of individual, your brother or sister, your wife's brother or sister, they're also a specified person, and their spouses, both their spouses, and their children and grandchildren. Okay, right? Their children and grandchildren are included. So which means that it's a large circle, and to this large circle, if there is any benefit going across directly or indirectly, your organization will lose the benefit of exemption under Section 11. Okay, right? We will see what are those benefits a little later, and I will take the other one. It also talks about any concern where any of these persons, A, B, C, D, here includes a person who has donated 50,000 rupees, 50,000, more than 50,000, okay, put it simply, more than 50,000 rupees, they have substantial interest. Let's take an example. When you buy from your church member who's donated more than 50,000 rupees for your school, you are buying from your church member notebooks, textbooks. What you buy from the church member has to be at competitive rate. There can't be any concession. He should not be charging anything more. Or take another example. I mean, we are a church. I'm just giving you an example. Let's say we are a church. I mean, we have grand churches also. One of our church member who's been contributing is also engineer by qualification. So what we do is that we give the construction work to him, and whatever work we give to him should be at the market rate, should be comparable. You need to take quotation and establish the tax department that what rate I am paying is the competitive rate. If the department says that, no, you're paying more, then we are in for trouble. Okay, Section 11 exemption is not available to us. And this is for individual. If it is a partnership firm, his interest is okay if it is 20%. Sorry, 21% or more than 20%. Even if it's a minor partner, the other partner may hold 80% share or 79% share. This man will have only 21% share. That's it. That's enough for invoking the specified person clauses. Section 13(1)(c) benefit to the specified person, and you are in for trouble. So whenever there is any transactions with the trustees, the relatives, the founders, the donors, the board members, please be careful. And this is applicable even because they are using the word manager of the institution. It could be interpreted to mean even at the lower level also. So it's better that we are careful with our dealings with our board members or people who have substantial interest, how this contributed to us more than 50,000 rupees. Okay, right? Let's look at the benefits, what those benefits are to the specified person. Please note that this is only an illustrative one given by the tax department. This is not an exhaustive one. If there are any benefits going across to the specified persons, then you lose tax exemption. Section 11 will not be available. First one, income or property of the trust is lent during the previous period without adequate security or interest or both. When you give your property or when you give your income, let's take the example, you give loan to a person. Here is an example. This is a court decision, okay, right? Allahabad Airport decision. In case of Ayub, Earth Educational Society. The treasurer was given a loan, and they passed the minutes in the board meeting saying that he would pay the loan with 10% interest. Okay, he will pay a loan with 10% interest, but he did not pay interest, or the interest amount is not shown as accrued in the books of account. So court said you have lent income without adequate interest. Okay, right? There is another one, Travancore Education Society. The capitation fee charged was shared by the trustees. What took the view saying that you have taken the money, you have used the money. So the property or the money income is lent to the trustees without adequate security or both. So what should be the interest rate? It's a very interesting question. What should be the interest rate? We are talking about adequate interest. What should be the interest rate so that department will not bother us? It should be ideally, at least it should be bank deposit rates. Supposing the trust goes and puts the money in fixed deposit, you should earn at least the bank interest when you give it a loan. Okay. Not necessarily bank lending, then at least it should be bank deposit rates, you should get that. The next one, land or building or any other property made available without adequate rent or other compensation. This is a classic judgment gone up right up to the Supreme Court. Okay, right? This is in the case of Bharat Diamond Rose. I think this has happened in Surat. Okay, in Surat there was a Diamond Merchants Association. So they wanted to have their own property. So they gave a large amount of money. If my memory is right, I think they gave about 70 lakh rupees to one of the directors. and told him to buy the property or to buy a land and construct. This man kept the money, there was no action taken by him. And this case was taken up for scrutiny, and then the officer noticed that the director took the money and he was not giving any other compensation, no rent, nothing, I mean, no interest, nothing. Not only that, he is not purchased or constructed the building that he was supposed to do that. So Section 11 was withdrawn. They were asked to pay taxes, and they went right up to Supreme Court. And the Supreme Court confirmed, saying that the director benefited from the amount that he has taken. See, end of the day, they might return the money, but what department looks at, what court looks at is that you have used this money for some time, which is public money, and you are not supposed to do that. Okay. The next one, salary or perquisites or other allowances paid, which is more than reasonable. Income tax law does not prohibit payment of remuneration to trustees. Tamil Nadu Societies Act has some restrictions. Income Tax Act does not prohibit payment of remuneration to trustees or to the board members. Okay, right? Or board of trustees. As long as the the trustees are paid for the services rendered. When they do some services, for each of the trustees are paid, then there is no problem. Then there is no issue at all. But if they pay only because, but if they pay only because it's a trustee, then there is a problem. And they have not mentioned what is reasonable remuneration, what is reasonable. So reasonableness will have to be looked at in comparison with the similar organization. I mean, similar organization in terms of the size, number of employees working, the amount that you are spending or applying or utilizing for the charitable activities, the nature of work that you are doing. All these things we look at and then decided what is reasonable or not. Okay, right? And also they will look into the qualification of the trustee or the director, board member. If they are qualified and have experience, you can pay that. Okay, right? And I've given a decision here where the trustees were paid remuneration more than arm's length, but they did not do any work. Okay, right? They did not do any work. So when the Delhi Tribunal said your withdrawal of exemption 11 is valid, they upheld department's one. The services of trust are made available without adequate compensation. As I gave illustration, like for example, the trust runs a school, the children are given free education, you're in a hospital, the trustees are getting free treatment. Okay, these are all in trouble. Supposing you employ a person and there is a valid employment agreement with him, wherein you mention saying that the employee, for example, even if the trustee is appointed as a managing trustee, he will be paid so much as remuneration. He will be given rent-free accommodation. He'll be in the school, in the hospital. He will take treatment up to this amount. This will be free. If this is there in employment, and if this is comparable with the other organization, then there is no problem at all. Only when, in the absence of any of this specific approval, right, appointment letter will be a problem. And again, please remember that it has to be reasonable. Okay, right? If it is not reasonable, then there will be trouble. And the last one, income or property of the trust. It includes property also of the trust diverted in favor of the specified persons. I mean, we all know that, but let me just share, a court decision. This is an unfortunate decision. In fact, most of the speakers who talk on this subject will, without any doubt, touch on this Agape Child Center. This was a children's home in Cochin, if my memory is right. During the time of renovation, the refrigerator was kept to the managing trustee's residence. It was there in the home, it was kept to the managing trustee's residence. The accountant faithfully recorded the asset register refrigerator managing trustees residence, place of use. And at the time of hearing, the officer said the managing trustee is getting benefit. And how many years old benefit of refrigerator, do not know. The poor man, he kept the refrigerator on because otherwise it will get repaired. So, and the assessing officer said, the trustee was getting benefit, and they withdrew section 11 exemption. Commissioner said he's not eligible. Tribunal said he's not eligible. Kerala High Court also confirmed that section 11 is not available to them. Exemption is not available to them. So please remember, all these violations, right, will drastically affect the organization. Till last year, in 21-22 financial year, if you violate, your gross income was taxed. Okay, thankfully, last year, government introduced the changes in the section, and what now they say is that it will be only the violated portion will be excluded from the income, and it will be taxed as income and then taxed at special rate. Let's say you have given loan to the trustee about 2 lakh rupees, okay, and this loan is not interest bearing. This loan is given interest free. So department says you have violated section 13(1)(c). Only these 2 lakhs will be now taxed, not the entire income. In fact, we have an organization, a similar case, where tax department said there is benefit to the trustee for an amount of 2 lakhs and less than 2 lakh rupees, and they levied a tax and interest close to 50 lakhs. Okay, it was more than 40 lakhs, close to 50 lakhs. We are fighting before the commissioner appeal. We have not still got a favorable order. Okay, even though we cited the board circular also saying that the violated person should be taxed, but so far we have not got an order. But now we are very hopeful. But thanks to these new changes, we will get a favorable order. So please understand, when you violate now, when I'm not telling you can violate that, but I'm just giving the provisions. If there is a violation under section 13(1)(c), the benefit to the trustees or the board members, only the benefit will be taxed, not the entire income. Okay. Similarly, we talked about investment other than 11(5). When you put money in private places, when you violate 11(5), section 11 was not available. Now, what the change says is that it will be only the violated portion. What amount you are invested in other than 11(5), that alone will be taxed at tax at special rate, not the entire income. Section 11 will not be installed. Only the violated amount will be treated as an income, and it's taxed at a special rate. Okay, any doubts or any clarification, I'll just give a minute's time, or you put in the chat box. Then I'll continue. Along with the beneficial clauses for section 13(1)(c) and 13(1)(b), benefit to specified person and investment other than 11(5), government also inserted a new section 271(aa)(e). All these years, when the government says that the trustee has taken benefit, the trustees were not penalized. In fact, I used to go and tell the officers, whenever they taxed, whenever we withdrew, I used to tell them, why are you penalizing the beneficiaries, the children? And you're asking the trust to pay such a lot of amount, and where is the money? At the end of the day, they may close their activity. In fact, that has happened for a few organizations. They may close the organization, and the beneficiaries will be the sufferers. The children's education is lost. Children who are staying at children's home, they will not get the benefit. why are you taxing the organization at such an exorbitant rate and just leave the trustee scot-free? If you think that it is the mistake committed, then it is because of the trustees, because they are the people who are brain began running this organization. Then you should only penalize them. So now government says that, government, of course, not because of me, right? I'm sure there are others who are represented. Government saw the main reason. And now they say that if any trustee violates section 13(1)(c), gets any benefit, in the first year, he will be asked to pay as penalty a sum equal to the amount of violation or the amount of benefit. Okay, the first year, supposing you violate year 1, I talked about 2 lakhs. Year 1, you will be asked to pay 2 lakhs as penalty. Okay, right? You'll be asked to pay 2 lakhs as penalty. Supposing he continues that mistake, the second year for 2 lakhs, he'll be paying 4 lakhs as penalty. Subsequent year also, if it continues, he'll be paying 200%. Please remember, if he continues with this problem, with this violation, you may lose your tax exemption. I will talk about it a little later. You may lose your tax exemption, and that will be disastrous. So, by mistake, if there is any violation, correct that and don't repeat it in the future. Okay. And quickly move on to the registration and revaluation thing, because the reason why I've taken it is that in my earlier seminars, not this time, earlier seminars, I was not talking about registration and revaluation at all. And I get some organizations coming to me for FCRA consultation, and their FCRA is denied. So when I want to file the revision petition, when I asked for details, I found that their registration, revalidation, all are not done properly. And thankfully, government has given one more window now, till 30th September. Original date was, I think, it's 2021 March. Then they extended to 2022 March. Then they gave time up to September. Then not September, I think June or July. Then they extended up to November, some date, November. And still a lot of us, including one of my clients, they could not complete that. They came to us quite late. And thankfully, government has opened the window for all of us who have failed to complete our process by 30th September. So please use this window. That is why I'm trying to explain this. There are, supposing you're an organization applying for the first time and you have no activities, right? You do not have any activities at all. Then you are eligible to go for provisional registration, okay, right? And you're a new organization. This is for the fresh or first time registration, and no activity has been commenced. When you have no activity, you can go for provisional registration, okay, right? And once when you apply for provisional registration, commissioner will process your application and you'll be granted a provisional registration. When you make for the first time, the first registration, commissioner will grant provisional registration within 1 month's time. This is all handled at the central processing center, CPC Bangalore, and you get automatically. Okay, right? And the provisional registration is valid for 3 years. Okay, from the year in which you're getting that. And subsequently, people who have provisionally registered, provisional registered organization are those who do not have any activities. Okay, they are new trust, new organizations, and they applied and got provisional registration valid for 3 years. And when they start activity, within 6 months of the commencement of activities, they need to go for regular registration. An organization, new organization without any activity, first register yourself provisionally. The provisional registration is valid for 3 years. And when you start activity, within 6 months of your activities, commencement of activities, you have to go for regular registration. Okay. this 3 years is not valid. Okay, right? 3 years is not valid. In case you have not commenced any activities, so you need to apply, I mean, for regular registration 6 months prior to the 3 years. But I tell you, you will not be granted registration because you're not having any activities. Why should the commissioner grant you registration for an organization which has not done any activity for the last 3 years? Okay, right? So when you commence activities within 3 months, you'll have to do that. I mean, I've got two or three organizations that come to me. They have applied for provisional registration, but they have not gone for the regular registration. When I told them you have gone, their auditors said, no, we have 3 years time. Please note that you are not having 3 years time. If you have started activities, you must file the application within 6 months time. If there is anybody listening to me now, if you have started activities, please use this window now and file the regular registration and get it done. Okay, right? The next one, direct registration. Of course, this is applicable from 1/10/2023 only. This is for the organization who already have activities, right? They already have activities, but they do not have tax exemption. Okay, they have not enjoyed tax exemption. Either do not have 12A or 12AB or 12WA, or do not have 1023C. They do not have registration. So such organization can go for registration, direct registration. You can apply. You can apply for direct registration. Okay, right? And these are the 4 categories of people who will go for regular registration. The provisional registered organization, okay, the provisional registered organization, within 6 months, provisional registration is new organization, within 6 months of the commencement of activities, or 6 months prior to, which is 3 years, okay, they'll have to go for regular registration. Direct registration, those who have activities, those who are already doing activities, but are not enjoying 12A or 12AB or 12WA or 1023C. Okay. Then revalidated organization. I am not talking much about it because this is the organization that already have 12A or 12WA and they've got their registration revalidated. Okay, and almost all of us have got our registrations revalidated. And this revalidation is valid for 5 years. And we need to file an application 6 months before, before 4.5 years, okay, right? You need to apply 6 months prior to the expiry of the registration. So before 4.5 years, you need to file for the regular registration. Provisional registration within 6 months of commencement. Direct registration, if you have commenced activity, you go for registration regularly. Revalidated organization within 4.5 years, you'll have to go for registration. Of course, revalidated organization, this is not due for you now. You still have time. Last category is that in case you modify your objects, okay, please note that in case you modify your objects, you have lost your registration. You don't have 12A anymore. 12AB is not available. And you have to file for fresh registration, fresh application here. You have to file for fresh registration and a direct registration category, and you have to file within 30 days of any change or modification in your objects. Okay, right? I'll put it in the form of a chart. So let me just explain this to you. This is the new trust. Okay. And no activities. You go for provisional registration. 12A and then subsection, you can go through that. Provisional registration is valid for 3 years. And you'll have to go for regular registration within 6 months of commencement of activities, or within 3 years within 6 months before the expiry of this 3 years. Okay, right? And you'll have to go for the regular registration. The regular registration will be valid for 5 years. Okay. And the organization having activities but not having tax exemption, You have to go for regular registration. This will be valid for 5 years. Those of us who are already having 12-year, 12WA, we need to revalidate registration. That could be a case some of us have not been revalidated it or done it under the wrong one. There are organizations I've come across, they have done it instead of doing it here, they have done it under this section. If you have done it under this section, please withdraw this application and file under this, okay, for revalidation. Once when you revalidate your organization, then 5 years, all these are 5 years valid. Once when you get 5 years revalidation, all the three of you, you'll have to apply for renewal. This is 6 months prior to the registration date. Your registration, regular registration is valid for 5 years. So you have to apply, all the three of you will have to apply for renewal. This is when your registration is valid for 5 years, you have to apply for that. And then there is a modification of the object. You need to apply for regular registration because the moment when you touch an object, your tax exemption is gone. Okay. Right. Any doubts if you have, please put it in the chat box. I'll move forward. I'll go to the registration part of it and then I'll move forward. Okay, let me proceed. Once when you file for the regular registration of a provisional to the regular registration, okay, or the renewal registration, because revalidation is very simple, they don't ask for any question. When you go for renewal, all the three of them, all even revalidated, when you go for renewal, okay, right? So not revalidated, provisional, and also the first time registration, the regular registration, okay, right? All the three of you, when you go for the registration process, renewal process, this is what the commissioner will do. He will call for documents or information or make inquiries as he thinks fit to satisfy himself about the genuineness of the activities of the trust. Okay, what is genuineness? That activities are not false or not what it appears to be. It is true, it is genuine, it is happening, okay, right? And the objects, whatever you're carrying should be as per the object. And the next one, very important one, you'll also look for compliance of any other law for the time being in force that are material for the purpose of achieving your objects. This is a very, very, very important condition. I hope you understand the impact of this requirement. The commissioner will not look into only the income tax compliances. He will not only look into the income tax compliances to see whether you are complying with the income tax requirement. He will be looking into compliance of any other law that are material for the purpose of achieving your objects. Okay, right? So please note that, or please understand that Commissioner of Income Tax, the Exemptions Commissioner, he handles thousands of organizations. And he and his department, his offices, and the staff will have much better understanding than what you and I have. I may be handling only about few schools, whereas he is, handling hundreds of schools under him. And he will know the various requirements because each school will come and tell him, this is what required. I'm complying this, I'm complying that. And when they make a chart, they will definitely question you. In fact, when I applied for exemption to one of our Christian schools, they are not, Christian schools means, Christian managed schools. They are not giving this right to education privilege. So the commissioner asked, why are you not giving it? In other words, what you want to do is that you wanted to say that you're not complying with it, I want to cancel your registration. We are going to see what is the consequence of cancellation. So they have when I applied for, home, children home registration, immediately ask for social welfare board registration, recognition, all the other, permission that we have, show to me, and you ask that. So he will be well conversant with all the other laws. See, there are different laws. Many of us are found wanting in the society law. Okay, right. Many of us, we don't file our returns, annual returns in time. We don't file our amendments in time. We have issues with the department. These are all pending for 10 years, 15 years like this. Please get it regularized soon, because the commissioner has the power to cancel your registration. I will talk about the consequences of cancellation. Okay, right? And the next one is income tax. We are already talking about that. FCRA. If there are any violation in FCRA, if the commissioner says that your registration in FCRA is valid, is necessary for carrying out the activities. Take the example, you're an organization dependent mainly on foreign contribution. 80% of funds are from FCRA, foreign contribution, sorry, from foreign contribution. And if you have issues with FCRA, commissioner can say that your major donors are foreigners, you get foreign contribution, you have issues with this. Why I should not cancel? You have to find a reason. GST. Many of us think GST is not applicable to you. GST is applicable to many of us. And if you violate GST, it can be a problem. Labor laws, PEF, ESI. There are so many labor laws we have. We have a labor one of the director of the labor department, and I'm sure he's attending our session today. Once it was so happened, I was not aware of that labor law. I was almost arrested. Thanks to him, I was not arrested. Okay, right? So many laws are there. It is your duty to find out what are the laws that are required, that you need to comply with. Apart from all this, there are sector-specific requirements. If you are a school, as I told you, Right to Education Act, okay, will be there. If you are at home, Juvenile Justice Act is there. Okay, right? And for every one of us, this POCSO Act will be applicable.
Wait.
Then, there are special acts. All of us need to have some, committees, for the sexual harassment, against sexual harassment of women. Many. And it is you who are expected to know, not the chartered accountant, not the commissioner. If the commissioner says you're not fulfilling that, then you are in for trouble. So please find out what are the laws applicable for you to carrying out these activities and fulfill all the laws. Okay. Companies are expected to have a compliance officer. I would suggest one of you take up the role of a compliance officer, find out what are the regulations that are applicable to you, note it down, and make sure that you are compliant of all these things. Okay, right? And once when the commissioner is satisfied, then he will pass an order granting you registration for a period of 5 years. If he is not satisfied, then he will cancel your registration also. Of course, he will give an opportunity for you to explain. After that, he will cancel your registration. Next, we'll take the cancellation of registration. Any doubts, any queries, you can please put it in the chat box. Commissioner can cancel not only registration, even the provisional registration. Provisional registration is maximum valid for 3 years. In normal cases, it is valid only for 6 months from the date of commencement of activity. Even that commissioner can cancel when then he notices on his own, when it comes to his notice, specified violations. We'll see what are those specified violations. Then at the time of income tax hearing, scrutiny, the assessing officer, the income tax officer, assessing officer refers to the commissioner saying that there are violations that deserves the organization's registration to be cancelled. Or they have their own risk management strategy. Okay, in that they will pick up your case and then they will see if it is a fit case for cancellation or continuation of registration. So on 3 counts, commissioner can initiate cancellation. Let's understand what are those specified violations are. Number 1, when your organization registered for religious purposes, or charitable purposes, when you use the funds, when you apply the funds for other than the objects of the trust. I have been repeatedly telling right from the day one, whatever the funds that you're receiving, use it only for the objects of the organization. Whatever may be your good intention, if it is not as per your objects of the organization, you are in trouble. I just now told you, you cannot amend the objects also. In the sense that the moment when you amend, your exemption is lost, you have to go for fresh registration. So please note that all your activities should be only as per the objects of your organization. Second one, in case you have business activity, in case you run any business activity, that business activity should be incidental to your main objects, incidental attainments of your objectives. And you should keep separate books of account. If one of this is missing, then he will initiate cancellation. If your business activity is not for attainment of your objects, it's not towards achieving your objects, then you're in trouble. It is towards achieving your objects, but you don't keep separate books of account. Then again, you're in trouble. Okay, right? So please remember that. Now, third violation. When you apply your income, when you're a religious trust, when you apply income for private religious purposes, we already discussed that under section 13(1)(a). Okay, when you forfeit your registration, when you lose your 11 exemptions, okay, right? Similarly, when you're filing this renewal application, revalidation application, or the provisional registration application, you have given any false information or incorrect information or incomplete information, okay, right? Then that can be the reason for cancellation. Why? Because our application at present is processed only by the computer. No officer is going through your application. Only when you apply for provisional registration, from provisional to regular registration when we go, at that time only commissioner goes through your documents. Regular, in case of revalidated registration, at the before 4.5 years, when you apply for renewal, only at that time you will go through your documents. Otherwise, he will not go through your documents. So, in case the commissioner, the department comes to know that you're not given the complete information, you have hidden some facts which are material, or you're given some false or incorrect information, then the department can take that and use that to cancel your registration. The next one, 13(1)(b), we discussed that. Charitable organization, income is applied for religious purposes. We have discussed this enough, so I'm not going to spend more time on this. And your activity is not genuine. In fact, we already talked about it. Your activity is not genuine. So the dictionary says it is not real, or it is not exactly what it appears to be, or it can be artificial. Not genuine means, okay, not actual, not real, not true, false, fake, not sincere, honest, okay. If the commissioner says that the activities are not genuine, okay, based on all these things what we discussed, or your activities are not carried out in accordance with the conditions subject to which you are registered. Many of us know when we got our revalidation, we got conditions which were practically not possible, but later on government department came out with a circular intimating the new conditions which are very easy to comply, which are normal one. I will share that. I'm not going to explain that. So you'll have to comply with that. If you miss even the small complaints, then you're in for trouble. Okay, right? And we already discussed enough about complaints of any other law. Okay. When you don't comply with any other law, commissioner can initiate cancellation. There I talked about registration. Here for cancellation, commissioner can initiate cancellation if you are not complying with any other law, which is material, for the time being for achieving the objects of the organization. Supposing, let's take an example. You have an PF issue, and you file an appeal, or you contest that. in which case the commissioner will wait for your appeal or a contest or the dispute to come to a finality, and then only take action against you. Okay. Once when the commissioner gets this cancellation information, then when he gets this specified violations, then he will initiate the cancellation proceedings. He will call for the documents to satisfy that there are specified violations or not. Then you say, when he gets the information that there are no specified violation, then he will not cancel. If there is specified violation or other reason, then he will cancel your registration. But before that, he will give you an opportunity, okay, right? And he will pass the order. When he cancels, he will pass the order canceling the registration. And once when we cancel, your registration is gone for the year in which is cancelling and for all the subsequent years. Okay, all the subsequent years. Supposing your case is taken up for 2022-23, okay, right? And he cancel your registration for 2023. 2023 registration is gone, and all the subsequent years will be gone. Okay, right? And if he is satisfied with your explanation that you are not violated, then he will not cancel. He will refuse cancellation of registration, and he will forward the copy to the AO, assessing officer, income tax officer. And these are the conditions. I'm not going to talk about this condition because these are very simple. I'm going to share this PPT also. You can go through this, okay, right? And if you still have any doubts, so as I've been telling you, you can always put it in the chat box. We'll be willing to help you, okay, right? These are the conditions specified in the registration certificate. So, of course, these conditions were not given in the beginning, and later on, only in the start by way of circular, they have given it. 11 of 2022, they've given this conditions. Time limit for cancellation is that this is 6 months time is there before they may from the end of the quarter. Okay? So he has approximately 9 months time to cancel your registration. What are the consequences of cancellation? Okay. When your registration is cancelled, you will continue to remain as a public charitable trust. Just because your registration is cancelled, income tax registration is cancelled, you will not become a private charitable trust. You will continue to be a public charitable trust. Okay. And then the problem will be the benefit of section 11 will not be available to you. Not only 11, even 11(1)(a). 11(1)(a) is a capital gains. We talked about the beneficial clause of capital gains. That will not be available to you. Okay, right? And all the voluntary contribution will become income and will be taxed as a normal income. What is the normal income? Income tax is computed under different heads. The first head is salary income. Second is house property. Third one is PGBP, profit and gains of business or profession. Then other income. Okay, right? Both profit and gains of business or profession or the other income, what both the sections says that only the expenses incurred to earn income will be allowed as application. Expenses incurred to earn income will alone be allowed as application to you. Okay, right? And for charitable trust, tax department takes the stand saying that your income is voluntary. You don't earn that income. Take, for example, the church. They say that the church is offering given by people. It's a free will offering. You don't earn that. Or in case of an orphanage, which we run on free or collecting small amount of fees, department takes the stand saying that the donation that you get, people give it voluntarily. They don't, get any benefit. They give it voluntary. So I will not allow any direction against that. The only direction I give, or two directions I give, is that the one you get is the bank charges, because when you put a check, the collection charges I allow as application. The second one I allow is the depreciation on the assets which are not claimed earlier. Supposing you have bought some assets, I'll allow depreciation. Beyond that, I'll not allow any other application. So, moment when your income tax exemption is cancelled, your gross income for all practical purposes will be subject to income tax. What about corpus probation? There is a divergent view. there is one view is that corpus donation also taxable because it is included in the definition of income under section 224, corpus income. But there are also number of other decisions, which says that corpus is capital, makes capital reserve, and so it is not taxable. Corpus income or capital reserves are not taxable. But the safer view would be, in case your exemption is cancelled, take corpus main donation as income, and then try and use other ways of minimizing the tax liability. If you are planning to contest, then you may take corpus donation as a capital reserve, and then you can account that. Okay. Next is, as I told you, your gross income could be taxed possibly at MMR. Once when they cancel it, possibly it could be taxed at maximum marginal rate. And the most important one is that you will get into this tax on accrued income, chapter 12 EB. You can get into the chapter on exit income. Okay, right? 12 EB. We'll see this. Okay, right. What is this tax on accredited income? Exit tax from 15 TD. Just give me a minute, sir. I'm sorry. Thank you. On 3 occasions, this exit tax or tax on accredited income can come in to play or can kick in. Okay, I think that's a better way. It will force itself into you, the organization. Number one, first reason, when you are converting your organization into any other form, which form is not eligible for grant of registration under section 12AB. 12W is no more now. Okay. You are converting your organization into any other form, and that organization is not eligible for exemption on registration under section 12AB, because registration is given on 12AB, exemption is section 11. Number 2, you are merging with another organization, another entity that does not have this 12AB main registration, or under section 1023C. You are merging with another organization that does not have 12AB or 1023C. Take for example, trust merger is not possible. Society, it is very much possible. There are 2 societies. Society A is having 12AB registration. Section B, society B, is not having tax exemption. So what they do, society A and society B, they merged together, and then they come into existence as society A itself. Because society A is merging with society B, which does not have tax exemption, which is not registered under section 12AB or 1023C, tax on accredited income will come in, will kick in. The third one, in fact, I talked about it in the very first day when I talked about the conditions for exemptions. Okay, right? One condition is that in case of winding up, in case you're dissolving the society or the trust, the surplus, the remaining surplus, should not be pocketed by you. It should be given to another organization, okay, or another trust with similar objective. But your past resolution, you have taken a decision to dissolve your past resolution, you have done everything, and you need to transfer the assets within 12 months from the end of the month in which you have taken a decision. 12 months from the end of the month in which you have taken the decision. So supposing you take a decision to dissolve, let's say in the month of June, 12 months from June, okay, right, from the end of the 12 months, okay. It's been from July 2023 to June 2024, you need to find an organization and transfer the assets. Okay. If you don't do that, this tax on accredited income or exit tax will come into play. And when the first one I talked about is, an organization is not eligible for grant of registration under Section 12 AB, because 12WA is no more now, 12AB. When you are not eligible for grant of exemption, here is the most important one. The first one is that your registration is cancelled. Just now we saw that your registration is cancelled. Number two, you have modified or modified the objects of your organization. The moment when you modify, I told you earlier, your exemption is lost. And within 30 days time, you have to file for fresh registration. You modified and you have not applied for registration. If you have not applied for registration, then gone, tax on uncredited income will kick in. Or you modified, you applied for registration, but your registration was denied. You did not get the registration under Section 12AB. Then again, this accredited income will come in. The third one, the most important one for us. Organization, most of us already have 12A registration. We have not filed for revalidation. You have not filed in the correct form, the correct subsection. Of course, the form is Form 10A. You not file in the correct subsection. When you don't file that, that will be the reason for the department to initiate under the exit tax. Well, in fact, one of the clients for whom I went, because when they approached us, they came quite late, very late. So this window for revalidation was already over. So we thought with the available one, we will go for the first registration. And when I went for the hearing, the commissioner and the deputy commissioner said, John, you're not eligible, you cannot file this. And I told him, sir, there are a number of organizations that I know, are having trouble like this because, they have missed it up. They do not understand. And now, because of all these things, in fact, commissioner said, they are aware of all these things. They have recommended to the board to extend time, and they have extended time. So in case, please, I'm repeating, in case your organization, already existing under 12A or 12WA, okay, right? And you're not done the revalidation on the correct subsection, please sit with your CA and get it done. Okay, right? And also next one is that the renewal. Of course, this is not relevant right now. Provisional registration or registered organization. Within 6 months of commencement of activities, you have to file for the regular registration. Okay, 6 months prior to 3 years, I'm not going to talk about it. 6 months of commencement of activities. We do have a few organizations that have come to us, and we have done this provisional registration. Instead of repeatedly calling you, you're not coming. Okay, right? So please note that in case there is anybody who have this provisional registration, please come within 6 months. If you don't do it within 6 months' time, the exit tax or taxes on accredited income will kick in. What is the exit tax or tax on accredited income? Tax on accredited income means your aggregate fair market value of the assets. Okay, aggregate fair market value of the total assets that exceeds the liability. Okay, right? Let's take the example of your existing trust, existing for let's say 25 years. You have a small piece of land in which you have your trust office. That piece of land was purchased 20 years back for 1 lakh rupees. Today, the value of the land is 3 crores. And you don't have 3 crores with you, right? Just making it clear. You don't have 3 crores, but only the building. And God forbid you violated any of these conditions. For example, you do not file 12AB revalidation correctly. And you miss the bus. Tax department will come to you saying that you are not filed it. So exit tax will be applicable to you, or tax on accredited will be applicable to you. So on this 3 crores, you pay me tax at MMR. Okay, the MMR will be the tax, sorry. You pay tax at the maximum marginal rate. I already told you maximum marginal rate is close to 43%. In other words, in case you violate, you don't file your renewal application, revalidation application in time, this September, You have to forget your properties and everything and give it to the government and then go back. This is on the assets part of it. Not only that, your income, in addition to income tax chargeable, your income will be charged because you do not have registration now. Your registration is cancelled because already we talked about it. We already talked about the tax liability under cancellation proceeding. So you have all these risks. So better get yourself registered. I mean, under 12AB, either provisional register, get regularized, and also ensure that you don't, by any chance, may fall into any of these things. Okay, right? In case you're winding up, give the assets in time within 1 year. Not eligible for registration, grant of registration. My humble suggestion is that do not modify your objects. Okay, right? What may happen, you do not know. Right? And make sure that your 12AB is not cancelled and your revalidations are done correctly. When you do that, you don't need to worry about accrued income. Tax on specified circumstances. Let's see this, and then I think this will wind up. I'm sorry, today also it looks like we'll go up to 4:30. Kindly bear with me. Thank you so much for staying. We already talked about organizations where they violate, and because of the violation, it will be treated as income. I told you that application outside India, the amount of application outside India will be treated as income. When I talked about setting apart, or accumulation for a specific purposes, I told various conditions. When you violate those conditions, that becomes an income. Or when you deem a part of the income optional to section 11(1) explanation 2, because you're not receiving the money or it is received for more than 1 year or 2 years rather for next year, and you don't apply that, the amount so much not applied becomes income. It will become an income, and this will be taxed at a special rate of 30%. Okay, this specified income will be taxed at the rate of 30%. And please note that on this income, no deductions will be allowed. No deduction in respect of any expenditure, set off, or any loss, nothing will be allowed. Supposing let's take the example. I'll take one of those specified income. When you have income accumulated in excess of 15%, we already talked about it. You need to apply. Your income is 100. If you if your income is 100 and you need to spend 85 rupees, supposing you spend only 80, this 5 rupees will be taxed, right? I'm just giving 5 rupees, will be taxed at 30%. And against this 5 rupees, no other deduction will be available to you. Of course, this is after everything. So you normally don't look at any deduction under this. Let's take the other instances when this 30% special rate will be applicable to us. Number one is that you violate subsection 1B of section 11 or subsection 3 of section 11. What is the subsection 1B? This is the deemed application where you did not receive income, and what you say is that because I did not receive the income, I will apply it to the next year. Or the income that you received is meant for the next year, so you file an option from 9A and say that you will apply it the next year. 11.3. You set apart amount for a specific purposes. You need to keep the money in 11.5 investments. You have withdrawn that money. Okay, right? So much amount you have withdrawn from 11.5 will be taxed at 30%. No deduction will be allowed against it. So much of amount that you have not applied, what you said will deem the application the next year, you do not apply, will be taxed at 30%. Supposing at 11.2, we talked about a lot of violations. You have given that money as donation or transfer to another organization, loan to another organization. The amount of money of violation will be taxed at 30%. The next one, violation of section 13(1)(d). This is the investment in other than 11(5). I told you when I talked about forfeiture of exemption, any violation of section 13(1), section 11 was not available, and it used to be taxed on the gross income. But now the special computation mechanism under which this will be treated as an income, the amount, so much of amount that you have invested in other than 11(5) will become an income, and that will be taxed at 30%. Similarly, when you benefit specified person, the so much of amount that benefited the specified person, that will be treated as an income, and that will be subject to 30% taxes. And when you apply income outside India, that also will be subject to tax at 30%. Okay, these are the specified income subject to tax at special rates. The next one, next category of taxation. I also talked about it. There are cases where section 11 exemption is not available. This I talked about on the very first day, conditions for exemption, section 12. The first condition I said, you did not get audit report. Next, I said you do not maintain books of account. In fact, we talked a lot about books of account, and we'll be talking a little more about books of account tomorrow also. When you do not maintain books of account. Then third condition, when you do not file returns in time. And fourth one is that when section 215 becomes applicable. What is 215? When you do business activity, which is not directly connected or incidental to the purpose of achieving your objects. Okay, right? When you are violating section 215, this becomes a special category, because here also section 11 is not available. And here what happens is that because here this will not become an income. In the previous category, it becomes a specified income. Whereas here, this is a violation, and here the tax statement, the tax computation is different. There's 4 cases. 4 cases, what they say is that your income will be chargeable tax. Whatever is your income, it will be chargeable tax after allowing deduction for expenditure incurred in India for the objects of the trust or institution. Earlier, if you don't file tax audit report, gross income 30%. Right? If you don't file your returns in time, gross income 30%. Now, if you don't file four cases, what I tell, you don't keep books of account. It's not your gross income will be taxed to tax. Your income less whatever expenses you incurred to achieve the objects of the organization. Please note, I'm using the word expenses. I'm not using the word application. Whatever expenses you are incurring to achieve the object of the trust will be allowed as application to you. Allowed as deduction to you, not as application. Allowed as deduction to you. In other words, your capital expenditure will not be allowed. Okay, your capital expenditure will not be allowed. Earlier, we talked about application where I said your capital expenditure will be allowed as application. Okay, your capital expenditure will not be allowed as application. And what will be allowed is maximum depreciation, provided you do not claim the asset as application in the earlier years. If you not claim the assets as application in the earlier years, then you can claim depreciation. Any expenditure out of corpus will not be allowed as application to you. Any expenditure out of loan will not be allowed as deduction. I'm sorry, I'm using the word application. I'm really sorry. It will be deduction. Will not be allowed as deduction to you. Any application, any expenditure from loan will not be allowed as deduction to you. When you contribute to any other organization, earlier we talked about inter-charity donation is also an application. Here, then you violate, the cases now, what I talked about, when you violate that, inter-charity donation is not allowed as a deduction expenditure to you. Okay, right? So only after disallowing all these things, your income will be computed. For example, let's say your income is 10 lakhs, your project expenses is 6 lakhs, your admin expenses is 1 lakh, your contributor to charitable trust 1 lakh, your computer is 50,000 rupees, your closing balance is 1,50,000 rupees. If you fulfill, for example, if you file your tax audit report, there is no tax liability here. If you have kept books of account as is required under the law, under the rule 17WA, no tax requirement because you have fulfilled the 85% requirement. Okay, or if you have filed the returns in time, no problem. Here there is no business income, so let's not worry about 215. Because you're failed in this, what happens is section 1310 computation is coming to place. In which case, what will be allowed as application to you? You can claim as application 6 lakhs as application. You can claim 10 lakhs as application. So direction, I'm really sorry, direction. And your income will be 3 lakhs. Sorry, 3 lakhs. Let's presume depreciation. Okay, let me take the depreciation also. Let's take computers are depreciated at 40%. So it is 20,000. So depreciation on computer will be 20,000. So 7 lakh 20, 10 lakhs minus 720. On 2 lakh 80,000, I'll be paying taxes to the government. Okay, right? This is the way how your income will be computed. Then you're not, when you're failing with those basic conditions for exemptions. Okay, right? I hope this is clear. In case you have any doubts or any clarification, you can put it in the chat box. I'll try to explain, but unfortunately, we are overshooting the time. I may not have time to explain also. Okay, right. I'll try to explain that a little later. And this is a chart which gives you the special rates under various violations, under which section I have given that to you. And I'll share this presentation by tonight. You can go through this. Okay. And finally, the law is very clear. In fact, there were a few judgments which said that you can set off your the losses or carry forward your losses. Okay, right? I mean, what does that mean? Let's say in 1 year, your income was 100, whereas your application was 120. This 20 was allowed to be set off against future. But now this is not possible because government has made it very clear now. Each year is independent bucket. You cannot use this against other years. So there is no question of any set off or carry forward of losses. So each year need to be looked at independently and you don't get any benefit. Okay, right? I think with this, I will close today's session. I'm really sorry. I've overshot by quite a lot of time. I mean, at least about 15 minutes time. So I'm sorry. And if there are any questions in the chat box, I will answer that. I mean, please, I will not take any further questions. If there is any question, I'll answer that. Otherwise, you put your questions in the group, I'll try to answer that. Okay, thank you. Thank you so much. Thanks, Monisha. Cash payments should not exceed 10,000 per day as per 43. Is it whether per day or per voucher payment? It is per day, Mr. Fakiraj. Okay, right? It's not per voucher payment. Earlier, it used to be, like this. When there was an earlier restriction of 20,000 rupees, people used to have multiple vouchers saying that each payment was less than 20,000 rupees. Next is nominal rent for school building, which is in the name of the trustee, and the trustees are being educationally qualified or working in school under a paid reasonable size 50,000. This is going to be a little tricky one. This rent businesses, because of the building, who constructed the building? If the building is constructed of trust fund, there can be trouble because I recently read a judgment where the court took the decision saying that opinion saying that because the land belongs to the trustee, even if you have a long-term lease of about 30 years or so, at the end of the lease period, the building will go to the trustee. So there is a benefit to the trustee. So this is not applicable. If the land and building belongs to the trustee and nominal rent paid to the trustee is not a problem at all. As long as it is at market rate or less than market rate, is not an issue at all. And for educationally qualified people working in the school, this should be okay, 50,000. Compare this with the other staff salary also. Look at how much is the salary paid to the principal, the PG staff. And if it is comparable, then it is fine, absolutely fine, because teachers are paid much more than 50,000 rupees salary here. Government teachers are paid a good salary. So 50,000 should not be issued. Okay. Thank you. Any more questions? I'm sorry. I'm not taking any more questions. The questions, please put it for tomorrow. I'll answer the questions. Okay. Thank you so much for your patient time. I'm really sorry for overshooting. Thank you. We'll meet tomorrow. Bye.